Has inflation reduced consumer purchasing power? The real income of households has been negatively impacted by inflation, which has had a significant effect on consumer purchasing power. Prices for goods and services can rise faster than wages when inflation rises, which reduces what consumers can afford. In this video, we will highlight some of the significant impacts of inflation on consumer purchasing power. Number 7. Erosion of currency value. The purchasing power of money is essentially changed by inflation, which gradually erodes its value over time. Inflation is the general increase in prices for goods and services, meaning that consumers now have to spend more money to buy the same things that they could have purchased for less money in the past. For example, if the reported rate of inflation is 3%, then a dollar today will only be worth what 97 cents were worth a year ago. People with fixed incomes, such as retirees who depend on pensions or savings, should be especially concerned about this phenomenon because their income does not increase in line with inflation. They might therefore find it harder and harder to pay for needs, which would lower their standard of living. Consumer confidence may be impacted psychologically by perceived declining wealth, which could result in lower spending and additional economic slowdown. Furthermore, if people anticipate that the purchasing power of their returns will decline over time, they may be reluctant to commit their funds to long-term projects or assets, which can be discouraged by depreciation of currency value. This underinvestment can hinder innovation and economic growth, making the problems brought on by inflation even more severe. Number 6. Rising prices. The steep price increases for necessities are among the most obvious consequences of inflation. During inflationary times, prices for goods like groceries, gas, and housing frequently rise significantly, placing a heavy financial burden on households. Rising prices can force lower-income families who usually spend a larger percentage of their income on these necessities to make difficult decisions about their spending and budget. Families might be forced to forego healthier food options in favor of less expensive, less nutrient-dense options as food prices rise, which could have long-term health effects. Furthermore, rising housing costs can force families to relocate to less desirable areas or even face eviction due to housing instability brought on by higher mortgage rates or rent increases. In addition to having an impact on specific households, this circumstance may also be a factor in more general societal problems like rising homelessness and food insecurity. Beyond just necessities, rising prices can also have an impact on other services and goods that may strain household budgets, such as healthcare, education, and other services. Consumers may be forced to make difficult trade-offs between necessities as prices rise, which will lower their overall quality of life. Number 5. Impact on savings. The real value of savings is significantly impacted by inflation, which may discourage people from setting money aside for the future. The purchasing power of money saved eventually decreases when inflation rates rise faster than the interest rates offered by savings accounts. For instance, if inflation is running at 3% and a savings account yields a nominal interest rate of 1%, the real return on savings is effectively negative, resulting in a loss of purchasing power for consumers. This situation may cause people to believe that holding on to cash is less beneficial, which could lead them to prioritize short-term spending over long-term savings. Furthermore, since lower savings rates can result in lower levels of investment in the economy, which are essential for growth and innovation, this behavior may have wider economic ramifications. Long-term financial instability may worsen if people are unprepared for emergencies or retirement. The way that inflation affects savings can also have an effect on wealth inequality because individuals who can afford to invest in assets that increase in value over time, like stocks or real estate, may be able to maintain their purchasing power, while others who depend more heavily on cash savings may lose ground. Number 4. Income disparities. Not all consumers are affected by inflation equally, rather it usually widens already existing income gaps in the economy. Households with lower incomes are more susceptible to inflation because they devote a larger portion of their earnings to necessities, which frequently experience the steepest price increases. Higher earners, for example, may find it more difficult to pay for heating or transportation when energy prices rise, while those with lesser incomes may find it easier to absorb these costs or make investments in energy-efficient solutions. Wealthier households may profit from inflationary conditions through investments in real estate or stocks that increase in value, which could cause the gap between the rich and the poor to widen. As a result, inflation can exacerbate poverty cycles by making it harder for low-income families to escape it, which lowers social mobility and increases economic inequality. The impact of income inequality can also be felt in terms of access to healthcare and education, as rising costs may make these necessities more expensive for those with lower incomes, thereby limiting their prospects for growth and overall well-being. Number 3. Consumer behavior changes. Consumer behavior frequently changes in response to the shifting economic conditions as inflation increases. Customers may become more frugal with their spending when faced with price uncertainty, giving priority to necessities and reducing expenditure on luxuries like dining out and entertainment. This change in behavior may cause firms to face a decline in demand for non-essential goods and services, which could result in a slowdown in economic growth. Furthermore, consumers may engage in panic buying, whereby they hoard necessities in anticipation of future price hikes as a result of their expectation of rising costs. This kind of behavior has the potential to produce brief market shortages, which would heighten inflationary pressures and set off a vicious cycle of price increases and consumer unease. This cautious approach may eventually discourage investment and innovation, since companies may be reluctant to grow or take chances in an unstable economic climate. The psychological effects of these shifts in consumer behavior may also be felt by people, who may experience elevated levels of stress and anxiety regarding their financial security, which could worsen their general quality of life and social cohesiveness. Number 2. Negative real income growth. Negative real income growth, in which nominal wages rise but fall short of price increases, can be the outcome of persistent inflation. For instance, a worker's real income practically drops and they have less purchasing power than before if they receive a 2% wage increase in an environment where inflation is at 4%. Households that are struggling to pay for necessities with wages that do not adequately reflect the true cost of living may experience severe financial strain as a result of this real income decline. Lower and middle-class workers may be especially affected by negative real income growth, as they may find it more and more difficult to pay for housing, healthcare, and education. This may eventually result in lower consumer confidence and spending, which would further undermine economic stability and growth. Furthermore, the psychological effects of financial instability can have an impact on one's general well-being and exacerbate stress and anxiety in those who experience it. Social unrest can also be caused by negative real income growth, because workers may feel that their efforts are not being sufficiently rewarded, which could result in demands for higher wages or even in protests and strikes. Number 1. Economic feedback loop. The likelihood of ongoing inflation can intensify the inflationary environment through a self-reinforcing feedback loop. The demand for goods and services may increase if consumers decide to spend their money more quickly, rather than save it in anticipation of rising prices. Further price increases as a result of this increased demand could strengthen inflationary trends. Furthermore, companies may raise their prices in response to growing costs, starting a vicious cycle in which customers anticipate price increases and companies raise prices in response. Because of this feedback loop, traditional measures like raising interest rates may not immediately affect consumer behavior and may not address the root causes of inflation, making it difficult for policymakers to effectively manage inflation. The economy may thus get caught up in a vicious cycle of growing costs and declining purchasing power, making attempts to reestablish stability and growth more difficult. In an effort to protect their economies from the effects of inflation, nations may wage trade wars or enact protectionist policies, which can further disrupt international supply chains and increase inflationary pressures. This can have geopolitical ramifications for the economic feedback loop. These points highlight the different ways that inflation can affect people and the overall economy, and they also demonstrate the intricate relationship between inflation and consumer purchasing power. Thanks for watching our video, and don't forget to subscribe to our YouTube channel.